All right, let's start our final segment here. Then we'll get everybody out of here by 11:30 or so. Unless you want to hang out and network, it's totally fine with me. So our final segment is our 1025 segments, commercial real estate market update, office, industrial, retail, multifamily. Moderating this segment is Matt Pedersen with Dakota REIT. Please welcome Matt and the rest of his panel.
Good morning, everyone. My name is Matt Peterson. I'm the president of Dakota REIT. I've been a part of the REIT for 7 years, serving on the board, and was recently elected back in June of this year as president. So very excited for the opportunity. We've got a great panel here. I'll kick it off. We'll ask each person to introduce themselves, their organization, give a little history, and then we'll jump right into it. So Chance, if you want to go first.
Good morning, everyone. Chance Lindsay, Senior Vice President, CBRE. CBRE is the world's largest full-service commercial real estate firm with more than 100,000 employees, and we're a Fortune 122 company. We have all facets of real estate between advisory, transaction, property management, facilities management, debt and equity, and a lot of other services that we do. I oversee the Fargo office between North Dakota and South Dakota, and I think we have been here for 5 years. So.
Good morning, I'm Tracy Georgery. I'm a principal architect with JLG Architects. We are a 32-year architecture firm that was founded in Grand Forks, North Dakota, and now we are in, I believe it's 4 states, North Dakota, South Dakota, Minnesota, and we just recently opened an office in Boston. We've got, I want to say 160 employees, but it feels like every day that number changes, so don't actually fact check me on that, but I think it's about 160. And I work specifically in our commercial division and lead portions of that division throughout the Eastern North Dakota and Western Minnesota region.
Hello, my name is Andy Westby. I'm the managing broker at Goldmark Commercial Real Estate. We are a local commercial brokerage here. We've been around since about 1981. We're still one of the region's top sales and leasing offices for this community. We also have a design and development team that helps people do everything from an individual office fit up to a large scale multifamily or residential development. I've been here up 6 years today. It's just my 6-year anniversary. I figured that out this morning. So.
My name is Rick Berg. I'm with the Berg Group and Alliance. I guess I dabble in real estate occasionally. I grew up as a broker, so all the brokers here, I value what you're doing. One of my initial things was starting Goldmark Commercial, and I would say that our company is almost like a venture capital real estate. We're looking for partners on a particular project, and we look for people that are better than us. This is why I'm excited for Andy going forward there.
Hello, my name is Mike Allmendinger. I'm the president of Kilbourne Group. Kilbourne Group's been doing mixed-use projects in downtown Fargo since 2006, and we're really focused on projects down there that are walkable. We're enjoying what we do. We have 35 team members that do development work, fund management, construction, and then residential multifamily.
Thanks, everyone. Let's kick it off with Mike and Rick speaking to some of the current projects that they're working on, projects on the horizon. I think we're all excited to learn about the status of current projects and what folks are working on. So let's start with Mike and Rick, if you don't mind.
Well, excuse me. I would say, just in general, we have projects in 7 states, and we're primarily probably 70%, 80% multifamily, and that would be divided between 55 plus and then just your normal multifamily. I would say that our main focus is probably outside of the downtown Fargo business area, because we've got such a good developer working down there. It's been kind of a strange market. I mean, growing up in Fargo, we've seen, I guess I was thinking about this when I first got into the business. I was 21. It was 1981. Interest rates were between 14 and 16%. I bought my first duplex on a contract for deed. I think I paid 12% interest. I put $50 down and I carried the rest on the contract for deed for $29,950. What we've seen obviously today is how that whole market has, the interest rates have continued to go down, and how that's really affected. And so I want to talk about interest and what I see happening going forward with that a little bit later. But one of the examples, I guess one project I thought about is we bought a about a 240 unit project in Tulsa, Oklahoma with a partner, and our partner was a manager, and it had a value add component. We went in there and did about half of the value add, and it was kind of an interesting that I'd never really experienced before, but we always would go and buy a property, fix it up, get it stabilized. Our approach is long-term hold, not to sell, but if you're going to flip it or sell it, you do all the work and then you sell it. What we found is there's a real demand for projects that have some meat on the bone. So what that means is you had this project, we redid the units, and the rents went up by $100 to $150 a unit. And we had an offer, really an unsolicited offer, but what they looked at is they said, okay, we can take what you've done here, and we know that if we do that, we can get this kind of a value for the property. And so we're not going to pay you that full value, but we'll pay you somewhere in between. And so we ended up selling that property, which is really unique for us to sell a property. But again, I thought it was kind of unique when you're looking at doing projects and putting projects, leaving some meat on the bone for the next buyer creates an opportunity.
Hello. So some of our projects are in downtown Fargo that we have working, that we're under construction right now, include 3 that are multifamily mixed use. If you're familiar with them, there's the old Goodyear site, which is called the Mercantile Project. There's a project right behind the black building, which is called Kessler. And then there's a project where it used to be the old Nestor Bar and Park Company, which is called the Landing. Between all 3 of those are about 350 units, and those will be opening this year. They all have some component of retail with them as well. And then in addition to that, we have the Woodrow project is under contract. The 102 project we sold this past year. We have a number of spaces that we're leasing out for retail. We kind of look at that, our portfolio, and say there's 12 businesses that we're looking to bring to downtown Fargo. We have about 6 term sheets out there right now, and continue to focus on the retail side as well.
Any other panelists want to comment on projects you're working on before we would transition?
All my clients are in the room, so I can't give any secrets away.
I'll mention one. Rick teasing me, but I will mention it. Everybody in this market has driven through I-29 and I-94 crosshairs, or the crossroads of those 2 interstates. We've recently launched a marketing for about 58-ish acres there. We're really targeting that to kind of the high-end corporate Class A office park. A lot of opportunities also for hospitality, some retail along 42nd Street. Really exciting infill project from the city of Fargo's perspective. So we're really excited to see that take shape over the coming years.
I'm glad that was mentioned. That's going to be an exciting project. Any further comment?
Sure. Yeah. We just put a handout out here between the last break, kind of shows some of the available listings that we have for lease or for sale. So that'll kind of tie into it. We have the former LSS building, available for lease that the Bird Group owns and operates right now that we have available for lease. And then we have a couple of other industrial properties that we're marketing for a couple of developers, High Development and Enclave. So we'll have a couple of those phases come in as well too, and some of our notable transactions that we've done through this year. So that printout.
Let's transition to an update on commercial leasing. Andy, your team at Goldmark, you produce a valuable quarterly snapshot that shows the trends across various sectors like office, retail, industrial. Do you want to share some key learnings and stats and maybe some forecast for 2022?
Sure, would be happy to. So I came from software. Matt and I actually got our start at Great Plains and Microsoft. So when I came into real estate, I was surprised by the lack of data in our market, the lack of objective data. Every broker had subjective data around, hey, we did this deal last month or this deal last quarter, but there wasn't really any place to get comprehensive data on the market. And so Goldmark has kind of taken this pretty seriously, and we've invested pretty heavily in tracking data on not just a quarterly basis, which we do a quarterly report. Talk to me afterwards if you want to get on that mailing list, but we do this daily. So we have a daily update to our data. And so I last night kind of crunched some real-time numbers. So let's go to office first. Office is a market and this is going to just, I'll qualify the data real quick. Fargo, West Fargo, Moorhead is what I'll talk about. And I'm talking about data represented through the brokerage community. So this would be on MLS, listings actively marketed. We have some owners in the market who market themselves. You know, West Acres Mall is an example. They don't go through the brokerage community. I don't represent their data in our data, correct? So from an office perspective, it's really kind of been stuck in neutral to a degree. If you look at the trend line of inventory available, it goes up, it goes down. It's just kind of treading water, and it's been doing that for a while now. You know, net absorption, we just kind of have a tough time making headway on that, and that's not uncommon to our market. I think that's kind of a little bit of a national trend. We believe vacancy is hovering around 11, 12%, probably. It's about 1.2 million for lease through the brokerage community right now. That's really similar. That number hasn't changed much from this point last year. However, we have seen more leases, more individual leases have been done. About 42% more leases have been done this year prior than last year. Total space, however, is a little bit down for leasing activity. So we're seeing more leases, but they're smaller. We haven't seen as many of the larger office leases in the market this year. Class A is the one that's growing the fastest. Inventory there is up about 50%. We're seeing some really nice Class A projects come out though, and generally those don't fill day one. So that's not surprising. It shouldn't be shocking to people to see Class A growing. There's demand there. It just does take some time to fill that. So on the office side, I mean, I don't see things changing significantly in 2022. I think it'll continue to kind of ride this wave of we go up and we go down a little bit. I don't see a huge change in the market coming, most likely. Rates probably staying fairly consistent. Some owners may be getting a little bit competitive on rates just because we do have a backlog of some space on the market, but overall owners are maybe giving a little bit more on incentives than they are on rates. Retail recovering pretty well. I think 2020, as everyone knows, was a tough year for leasing retail, at least for a good chunk of the year. So we've seen an increase in leasing activity this year. That is up, look at my numbers here, about 68% as far as square footage year over year that has been leased. We think vacancy is around 4.5 to 5% of the MLS data. But as I mentioned, Herberger's is sitting vacant in the mall. That's 120 some thousand square feet. So when we look at some of the owner occupied vacancies, probably closer to 7 plus or minus, we think. I would expect momentum to kind of continue in retail. It's just kind of this slow recovery, but it is improving. Really, there's been a focus on prime locations, and that's always in real estate, right? Location. Some of the subprime spots, we've got a lot of long listings. Average days on market for some of those properties is growing and growing. Those are the properties that are kind of struggling and will probably continue to struggle. So we've had some really nice new developments come up that are attracting the retail activity. And then on the industrial side, I'll just finish with that. I feel like I'm in Derek Zoolander, but industrial's so hot right now. It is the darling of the market locally. It's the darling of the market nationally. Some of our other panelists said the same thing. We are at a point where we are, from an inventory perspective, I think when we look at what is out of the ground and actually available to lease, we're at under 400,000 square feet. That's a fraction of where we were just a year or two ago. Now, there's new developments coming. So we've had some big spec projects. Chance already mentioned a couple from the Hyde development and the Variant 2 Enclaves project. There's some on Main Avenue. So we're starting to see investors now build more product and bring that inventory level higher. But it's a market we don't see slowing down, both locally and I'm sure nationally as well. I know we could fill a lot of industrial space if it was there, but we get calls and we just don't have options for them right now until some of these projects are there. So we see that market staying pretty strong.
Thank you. Do panelists have any other comments to add to commercial leasing update? Okay. Let's transition then to some recent transactions. Maybe start with Chance. Chance, would you mind sharing any recent deal flow that you've been a part of, maybe cap rates and maybe where you're seeing potentially cap rates going in 2022?
Yeah, for sure. Cap rates have been all over kind of the board for different product types and asset classes, and we can kind of go through some of these transactions that I have in the printout. We sold the Bank of the West Tower this summer to Bell Bank. That was one of the transactions that we did. It was a 105,000 square foot facility. I think Bell's going to make that their headquarters. And then Rick invested in the former LSS building, available for lease. Another property that we sold was the former Shotgun Sally's, Twin Peaks, right to the north here, came in. And we, put them in there as well too. And then we, 127,000 square feet. It's a spec development that Hyde is doing. We already have a lease signed for that property that'll be delivered in March of 2022. So we have a lease commencing then. And Enclave developed variant 1, which we were able to put Frito-Lay in there to sign a long-term lease. And it's been a wild year. We've also been involved in some of those other sales that we didn't want to put on here yet, but like Andy mentioned, the Herberger sale, we facilitated that transaction for L&R Partners as well, and we assisted in the Ryan development for Amazon and Ocean West Partners that acquired that asset on a 15-year lease. That traded at a high 4 cap range on that industrial property. Then, what we're seeing for industrial properties, we're probably seeing the low 6 and class A, class B, tertiary markets like a Fargo. And we're also seeing compression on multifamily, whereas this was probably traditionally a 6% cap rate market. Some of the core class A assets we're seeing compressed to, as low as a 5. Some people will get aggressive as a 4.75 for some of the groups that have come in. And ultimately we kind of see that, I got asked a lot of the questions later locally, what's 2022 going to look like? And, I think the capital markets group that was here earlier did a great job on tying to that, but we kind of see interest rates rising, but we don't see them rising sharply enough to kind of trade on the property markets. So I think we'll continue to see the deal flow go through 2022. And, the U.S. Treasury, I think, is going to remain pretty low. I think it's about 1.4, 1.5 early in December. We anticipate it's probably going to go up to about 2.3% in 2022. But I think that interest rate spread is still going to be compressed. And I think we'll still see activity from investors going forward into 2022 on a lot of different asset classes.
Thank you, Chance. I think that's a good transition to my next question too. Others chime in if you want, please. In terms of, to kind of set it up, CBRE has forecasted 2022 is going to be a record year for commercial real estate transactions. For what you've witnessed so far in 2021, what's kind of been the competition in terms of there been a lot of interested parties as deals come up, and are we seeing more folks from outside our community investing in the Fargo Moorhead community?
Yeah, I mean, ultimately, I don't know if anyone wants to jump in on this, but ultimately we are seeing a lot more construction locally and on a national level. Just to kind of tie it to, we're seeing probably 300, I'm talking on a macro level through our CBRE's report, and we can tie it locally, but on a macro level, there's over 300,000 units of apartments that are being delivered in 2022. Take this into perspective. We averaged about 206,000 units delivered since 2010. And prior to that, 1994, it was typically about 171,000 units delivered annually. So we're kind of seeing that push towards, housing. And then we're also seeing a strong push for single family rentals. So the single family home for rent is kind of it's really becoming a strong focal point for a lot of investors and REITs and developers across the country. And
Well, I'd like just to add to that. I mean, everyone here obviously has been involved in this game, but what's happened, in my opinion, is the institutional money has chased cap rates in the big markets, Denver, Minneapolis, Chicago, Phoenix. And now they've started in the last year, look at what I would call the Class B markets, the Fargo, the Sioux Falls, Omaha. Some of those markets are seeing, probably had 6.5% or 7% cap rates 2 or 3 years ago. They're seeing that compression there. And so, there's, from my perspective, what's going to happen in real estate, there's really a fundamental is supply and demand. If you're in a market and there's short warehouse, short apartments, it's going to get built and the rent will have to be what it is to do that. What we're seeing in other markets is people can't buy, or they don't want to buy at a 4.5% cap rate or a 4.25% cap rate. So then they're building because they can build and maybe build to a 5.5% or a 6% cap rate. So there's a lot of activity on that market. And what's driving this, and this is kind of, what is a cap rate? And I just caution everyone to be really careful when you're actually doing a deal and looking at just the cap rate. Because, we see a lot of things where they say, well, here's the rent and we put a cap rate on it, so here's what it's worth. Well, they don't take into account vacancy, they don't take into account expenses, repair, maintenance, et cetera. So really, it's important that you understand on a particular project what the cap rate is. And then, really what we're seeing generally is that cap rate is maybe a spread of, anywhere from 1.5% to 2.5% on what you can borrow money for, because our business is about leverage. And so the question that's been on my mind has been, what's interest going to do? Where is it going to be at? And there's, this day and age, you can hear anything you want to hear from anyone. And I think for us in the profession, it's important to kind of really be thoughtful on this. Today and tomorrow are 2 big meetings on the Federal Reserve. 6 months ago, they said, we're going to keep interest rates at almost zero until, number one, inflation is above 2%, and number two, we have full employment in our economy. Because the way the government works is they look at interest rate as kind of that throttle. If the economy is going too fast, then they'll raise the interest rate, that'll slow the economy. If the economy is going too slow, they'll lower the interest rate to kind of get things rolling again. Now, it's way more, that's too simple, because what we heard in the last presentation is there's a whole bunch of money out there. So I think you can look at what is the supply of money, and they're looking at obviously real estate. Last week, they said November inflation was 6.8%. The highest it's been in 39 years. Well, everyone wants to go to fixed assets because that's the best protection you can do in an inflationary period. However, it doesn't necessarily guarantee that things are going to go up that. And so I think for me, just on the national level, watch what the feds are doing, watch this inflation. They've kind of said it's transitory or it's transitory. And they're saying it's because of some of these bottlenecks, and we've all seen those bottlenecks. I think they're going to drop that word. But again, be aware of those things, because when you make a real estate investment, obviously it's long-term. So watch the cap rate. And then I guess backing up one more thing, a 4%, 4.25% cap rate may not be a bad thing if you're in a market where there's very limited supply and it's going up at 10 to 15% per year. And you can just build that into your pro forma and know that this, buying it today at this price, 2 years down the road, you may be at that 6% cap rate because rents have gone up.
Thanks for sharing. Other comments?
I'd just echo a couple things I heard that just to help validate from outside investors. One of your questions was, are we seeing people from outside of this market come in? I think we're seeing that most seriously on the multifamily side, people that are looking in other markets, like Rick said, maybe their focus was other ones and starting to look at Fargo, Moorhead, this area. So we're seeing more pressure from outside investors there. Industrial, probably the next, some, just because that's the darling nationwide. So I think people are looking for projects anywhere from an industrial standpoint. Office and retail, I still don't see a lot of interest nationally. That's largely still a local driven market predominantly here. I haven't seen a lot of pressure in those two markets from a outside the region perspective.
Chance or Andy or anyone else, have you guys seen investors maybe drop their expectations on quality of a property in order to achieve an historical return that they're accustomed to? Are they buying lower quality property that might trade at a higher cap is basically the question.
I think the properties that are moving generally fall more into that category than the nice high-end Class A type of properties. So in a way, that is happening because that's kind of the supply. The inventory really isn't flush with the really strong producing income, properties.
Yeah, I'll add to that and concur. And ultimately, much of the investors, like what Rick mentioned earlier, traditionally most investors in this market are not sellers of assets.
Yeah.
When you're trying to figure that, analysis out, the previous panel talking about taxes, that's our biggest issue when we are meeting with different owners about selling their assets is the tax implications and what that looks like into 2022. So that's been our biggest obstacle. And we have to look at, providing or putting those funds into the UPREITs, the REITs, the DSTs. So we've had to really go a lot further with a lot of these clients to kind of help them kind of see that, because when they're wanting to 1031, what am I going to place it into? Because cap rates are much more compressed. I know this asset, I like it. So we haven't really seen a whole lot of transaction velocity that we would typically see in a lot of these other markets across the country.
Thanks for sharing. Any other comments?
I would just like to add to that. When we were in Phoenix, I don't think anyone's owned a building longer than 5 years in Phoenix. It's all buy them and flip them, buy them. And of course, in that market, we saw in 2008, 2009, a lot of equity was destroyed. So, there's a rationale for that. But I would just, for me, Fargo is such a great long-term place. Like I said, I got involved in 1981. And if you look at that trend, Fargo's grown by 1.5% to 2.5% every single year for the last 40 years. And early in my career, I was always frustrated because it wasn't like, Fort Collins or Denver, they were booming like this. But there's also a downturn in those markets that goes down just as fast. And when you're leveraged, that downturn, wipes out your equity. So I just want to say that even though Fargo is not as sexy as some of these markets sometimes, it's just it's a great long-term market if you buy it right and take care of your property.
Yeah, I'll add to that and concur. Ultimately, my background's in single tenant net lease investment sales. So the average hold period was about 6 to 7 years once you reach your peak IRR, if you utilize leverage. So we had a lot of California investors and Arizona investors that were always trying to UPREIT and try to, they buy $1 million asset, hold it for 5 to 7 years, and then sell and try to get a $2 or $2.5 million asset and just kind of leverage up. What Rick kind of mentioned in the Arizona market, we have some clients there that are hitting their IRRs. They transition, they want a 7-year hold, but they've reached their IRRs probably in 3 to 5 years. And they have investors that are coming in willing to take them out, and then they'll move on and go find another asset. So those are the markets that are kind of going on across the country. And I think I did a research study here a couple of years ago. The average hold period in the Midwest here is about 35 to 39 years on an asset class. So there's not a lot of transitionary real estate and sales. So it's a lot different.
Wow. Oh, let's transition again. So let's talk about, now that we've experienced COVID and still experiencing COVID, how is that impacting return to office, construction, approaches to new development? So maybe Tracy, if you wouldn't mind starting off the discussion in terms of what you're seeing, how you're advising your clients, or if you're seeing any sort of trends in the types of amenities that employers might be looking for?
You bet. I think a few months ago, everybody was seeing and feeling the post-COVID desire to have everything turned to be sensory, touchless, everything, whether it was your plumbing fixtures in your restrooms to your, door handles, keypads, everything you could possibly think of trying to turn touchless. That's what everyone was wanting to do. And that lasted about 2 weeks. The reality is, I think that at least what I've been seeing with my clients is this kind of introspective, newfound depth and research into who that client is and what they're all about, what their values are, what their culture represents to them internally as well, externally to the community. And as an architect, it has been one heck of a fun ride the last few months. Not to say that we don't have clients that have been doing that for years, but it has been a double down effort, I would say, just in the last few months, because, companies are trying to figure out, how do they come back to work? What does that look like? Some companies are completely embracing this new digital footprint, that they don't need to have a physical office space. Some companies are absolutely adamant everybody has to be in the office, no questions asked. And then there's like 99% of the world that fits in between those two extremes. And so as an architect, it has been so interesting and difficult, yet rewarding, working with these clients, trying to figure out what does gathering for their office mean? What does community mean to that company? And so really the trends, if you want to call it that, and I feel like that term might be a little misleading, is that really there's a desire to understand what is the right office feel flavor for those companies. And it really starts to dig into, again, their culture, but how do you create experiential design that makes employees want to come back to the office? How do you celebrate coming back? Or if they're a company that they are wanting to maintain a more digital footprint, how do you create that sense of community digitally? And what does that look like? And it's just, there's so many components to it that right now to say that there's just clear trends, I think is completely a falsehood. Certainly there's some baseline factors that we're seeing. I mean, yes, everybody's now going to the touch-free toilets and so forth. A lot of people are really doubling down on improving their HVAC system so that there's more fresh, clean air being introduced into the spaces. This kind of whole holistic wellness approach to their spaces, I think, is very, very important. But it's really about the end user and how are we making these spaces really, truly important for the clients and for the customers or whoever that end user is. And the other thing I would say is it's all about creating the sense of community, whether it's a mixed use project, whether it's an office project. Community can be very different scaled depending on the project, but really understanding after being without each other for 2 years and we're all digital, all on Zoom or whatnot, I think we all have a newfound value set around being together in person. And how do we do that safely? And what does that look like long-term? And we don't know all those answers, right? But it's exploring that. And the last thing I would just say is, as an architect, you guys are making my job a whole lot of fun. Like, you're saying that Fargo isn't sexy. That's not what I said, Rick. Return my phone calls and we'll talk. You talk about Fargo not being sexy. I would say to the opposite, like, we're bringing sexy back. Like the Fargo, Moorhead, West Fargo, Dilworth community, there are so many exciting projects going on and we have so much to be proud of. And it takes a room like this just to keep that energy going and really realize that we're doing better and it's pretty dang fun to watch. So proud of you guys.
Thanks for sharing.
Well,
And the laugh.
I'd like to just add to that. I don't think COVID affected our market. That's maybe a bold statement, but I was stunned. I was very nervous at the beginning, worried about rents, worried about a lot of things. But what we saw is a lot of small business, they just said, I'm going to buckle down. I'm going to work a little harder and I'm going to cut my expenses. And I actually think that a lot of our businesses here in Fargo under the COVID got very lean and mean and focused in what their business is. And I think as our economy comes back, I think they're even going to be stronger. I think there were a lot of people that they also left their job because they wanted to start a new business, a new boutique or something like that. So we've always been an incubator here of new business and new ideas. And so I really think overall, COVID did not impact our market like it has the rest of the country. And I always worry about office space. And I don't, the jury's still out on that, but I remember back in 2000, Microsoft had this computer and they sent everyone at home and said, work at home. 2 years later, they required everyone to come back at work. And I think with COVID, when everyone went home, everyone was worried about their business surviving, and they were very disciplined and worked pretty hard. But I think what Tracy said is you miss the culture when you're at home. And so I really believe that businesses need to, through the space or through their organization, create that culture. And again, I think that's going to be a plus at the end of the day.
I would chime in there. I would agree with Rick on his 2 points there. One, in terms of the impact of COVID on the real estate market. And speaking from Dakota REIT, we very much appreciated locally owned businesses. They were the ones that acted the most responsibly. You used to think that you wanted, credit-worthy national brands as your tenants. And yes, they're still important, but they were the first ones to call and ask for an abatement on their rent, or to ask for an amendment to their lease. Of our 350 commercial tenants, only 40 of them asked for any sort of abatement or rent adjustment, and almost all of the 40 were brand names around the world that you all do business with, but the locally owned businesses were the responsible ones. I would also agree that when I was at Microsoft those 16 years, I saw it ebb and flow twice, where they encouraged people to work from home, and then they pulled them back twice into the office just the 16 years I was there. So I agree, it's going to be cyclical. Mike, I'm curious to hear your thoughts. I think the Kilbourne Group prides themselves in always wanting to create a unique experience for the end users. Tracy, you talked about it's all about the end users. Have you seen any changes in terms of your ways of design and development? Obviously seen changes in timelines and costs. How about the design?
Well, for office space in downtown Fargo, we think it's critical for downtown Fargo to have a good office presence in downtown. We have retail, multifamily, hospitality, and the office component certainly adds the activity and the vibrancy during the day that we know is really important as well. For us, we have a number of office tenants in downtown Fargo right now, and the conversation that we keep asking is when we're talking to a potential business about making a move to downtown is what are they thinking about for their team, and what kind of design space do they have? We have a number of buildings that I'll call them in the core and shell space, and then we're waiting to meet the business and then fit up the space to their needs. We think that particularly downtown Fargo will be a great location for companies when if they're evaluating what kind of space they want post-COVID. That may be trying to figure out who's working remote and who's going to be in the office, how many days, and really set their business up to change, because right now we don't think anyone really knows what that answer is going to be, 2 years from now or 5 years from now. So the areas that we focus on and where we think downtown Fargo could be a differentiator will be companies that really want to focus on collaboration, and then also work on building a culture for their team members in downtown Fargo. And that may be companies that are saying they're going to require their team members to be in the office for 2 to 3 days a week, and then maybe they're going to allow some remote working as well. We do think that many businesses are going to allow their team members to work remotely a couple days a week because it's competitive nature out there for workforce as well. And we think a lot of companies are figuring out how to do that with the technology advances over the past years. And they've been there those technology advances were there previously, but we all figured out how to use them pretty usefully, during COVID. At the same time, what we do hear from businesses is that they do see an important need for their team members to be in the office, because when they need to collaborate to solve problems, when they need to collaborate to create innovation, that's where they see the value of their team being in the office. And I think that's where, we hope the amenities of downtown Fargo can be that differentiator. So, we've certainly realized, downtown Fargo's office, office space provides a differentiation for downtown Fargo that's different than other places. Downtown Fargo's has, like I said, advantages for amenities that fits some businesses. Not all businesses value that. So we're doing our hard work to find the businesses that value that collaboration and culture. And I think that's where we will see success.
I'll add one thing to that. There's been so many phenomenal projects that have been popping up throughout the Fargo-Moorhead region in the last few years. But I think one of the biggest game changers has been the creation of Broadway Square. And the amount of activity and vibrancy that square has provided our downtown is it is so phenomenal. And if you all haven't had a chance to go hang out there for any reason, go grab a coffee and walk around and just try to leave that space unhappy. I dare you. It is it's filled all the time. Our offices are right across the street from it, and we get to watch all day long what's going on over there. And it's rare that it's not activated. So nice work. Great job.
I'll add to that. My office looks at Broadway Square as well too, and I saw some corgis running around on the ice last week, and I made my night. I was in there working. I was like, "That's pretty funny." So that was pretty cool. But no, I'll attest to what Tracy said about the looking forward in 2022. CBRE's, we put out that report that you referenced. We just put it out in early December that we can get to all you guys if you want. But we predict that office, we're probably 87% of office companies are going to have a hybrid model, and traditionally it's been about 4.4 days per week that people spend in the office or workers spend in the office. We're predicting that's probably going to go down to about 3.4 going forward. We don't know what's going to transition to in 2023, but in 2022 we're thinking there's going to be a hybrid model, and we're working with a lot of the consulting with a lot of the Fortune 500 companies to kind of get an understanding of what that looks like. And just to touch base on what Rick said earlier, we really haven't seen that hybrid in the Midwest here, where I think many of our clients went right back in the office right after, everything on the lockdown. So maybe lockdown's not the right word. I don't know, but we see a lot of people in the Fargo market, transitioning and keeping the office, 4 to 5 days. But I'm assuming that we'll probably see that hybrid model going forward for a little while.
Agreed. Last question on this section, maybe it's too early. Have any of you experienced any projects or investments where a property owner is repurposing a space to say from office to something else, multifamily, to try to drive additional value? Have we seen some of that either in Fargo or the other markets that you operate in?
I can say I've worked on quite a few different projects where the renovation project has been anything but typical. We're seeing a lot of properties where there's just some question as to exactly what it wants to be, or the pro forma works pretty well, but it's not quite there. And the introduction of Airbnbs into some of the spaces. And on paper, I shouldn't say on paper. In my mind, it makes absolutely no sense. And on paper, it totally makes the project work. So I think that's been a fun, I don't know if that would be considered a trend, but at the moment, something that's certainly popping up pretty readily.
That's cool.
For Kilbourne Group, when we first started doing projects in downtown Fargo, again, I always like to recognize that, the community came together 25 years ago, created a master plan and a vision for downtown Fargo. And it certainly, caught our attention and our founders' attention, and we started doing projects down there in early, 2006. At that point, we did speculate on the amount of retail, the amount of office and multifamily that we were going to make investments into. And I can tell you that we were probably more nervous about retail space when we first started, and retail has been doing well for us, and we're seeing a lot of success around retail, specifically food and beverage in downtown Fargo. The office space has been the space that we're challenging right now, as Andy was talking about. There's a lot of vacancy in the metro area. So I can tell you that there's two buildings that we're looking at on repositioning to multifamily, depending on what happens with office space here in the near future.
Thank you for sharing. Any other topics or comments before we move on?
I think locally, the most conversions we've probably all seen has been on the retail big box side. So you got the Kmart site that there's a plan now to kind of reconfigure with some retail and some senior housing and some other things. You look at Gander Mountain, large big box that was converted for more of a manufacturing type of thing. So that's a trend that's happening nationally. I think it'll continue to happen locally as well. It's just harder to fill big box retail than it was. And so those seem to be the ones locally and nationally that are getting the most conversion attention.
Great. Let's go. Now we're going to discuss kind of challenges going into 2020, maybe challenges that have already been obviously dealt with in 2021 and continues into 2022. I would ask if you'd like each panelist to answer the question of what's kind of the main challenge or challenges you're dealing with in your organization. How are you mitigating it or handling it? Maybe we'll start either end, up to you guys. Mike. All right.
Sure, I can
Take the lead.
So challenges, I talked a little bit about office leasing. That's certainly something that we're looking at different strategies and focusing on regularly. The other one is construction cost. We're a company that is building and developing new projects and working with our subcontractors to really understand where will costs be 6 months from now. How do we, go into contract together to manage whether there's COVID delays or whether it's material cost increases or delays in materials being delivered. There's a lot of contractual adjustments that we're making to, really try to manage risk for both subconsultants and us as the developer.
Are you gonna go to the other end then and bump?
Sure.
I need a little more time.
All right, we're dropping.
Thanks, Rick. Yeah, exactly. To test what Mike said, challenges are definitely something that what we're seeing on construction, on new development, timelines. Let's just say, for example, some of these industrial projects, the new development, those projects, the lead times, for the roof structure, your lead times used to be 4 to 5 weeks. Now it's a year. For finding contractors and getting bids, a lot of people are busy right now. So, increased construction costs. I was talking with a developer when, lumber prices were way up and they were going to do a mixed use project. They rebid it. Lumber was $2 million more, and then they rebid the project. The lumber went down by $2 million, but the cost to build it and the steel went up by $2 million. So it was a net same when lumber prices went down. So I think going forward, the unknown is where interest rates are going to go, and then ultimately the user market on the office side of things. We've gotten a lot of activity on our office properties that we have. So we're just trying to figure out where that is and who the best fit is for those spaces. So we're starting to see those companies start to move again and make those decisions here locally. And, I think that's just the biggest challenge that people are trying to figure out. On the industrial side, it's timing. I mean, we have probably about 250,000 square feet of space that tenants are wanting, but they want it yesterday. We can't deliver it. And we're looking at probably midsummer, late fall for some of these deliveries. And we don't know if they're willing to wait or if they're going to go to other markets to try to, so it's kind of a race from the industrial side of things. And so that's kind of some of the things and the challenges that we're seeing in 2022.
Good visibility. Thanks.
I think from my standpoint, there's two main challenges. One is finding great employees. Right now, we're just in such a growth mode. We've got so many wonderful projects. It's just keeping up with the pace. I got to serve these guys. And it's hard when you don't have all the right team on or in place at day one. But the other thing, obviously, as everyone's mentioned, is the supply chain issue, the timing. Part of my job is to provide cost estimates that are fairly accurate for these projects to move forward. And that's hard right now. We've got projects that are bidding. We have a great big project that just bid 5% under. We have projects bidding 30% over. And the volatility is just so immense that it's hard to know what to do. Timing is really difficult. Structural steel being a year out is a real thing. We have issues where we've got some smaller projects where we can't even get framers to bid on the projects. We can't get concrete guys to bid on the projects. So it's a matter now of trying to figure out how do we get scrappy and creative to try to find some solutions around that? How do we reimagine or rethink the construction process? So we have had some projects recently where we're actually starting to employ like dirt wall systems, these pre-manufactured walls, because they can bring them on site and it's ready to go. You know, I wouldn't say it's quite plug and play, but it's getting darn close. Where a few years ago that for a lot of projects that was just cost prohibitive, that's becoming a really reasonable solution right now versus not having half of the construction team on site to be able to actually build the building. So again, it's just kind of reimagining and trying to problem solve in a whole different way.
I'll echo Tracy. I think labor, I think everyone in this room probably could use more help. I know our design and development team is overworked and we'd love to add another member or two there. On the brokerage side, we're doing more deals than we've ever done. And so, you know, more capacity there would always be great, but finding that right person or right people is always tough in this market. And we're in the business of helping people buy, sell, and lease. And there's a lot of friction in deals. So on selling, Chance going to mention this. We've got people that would like to sell, but they don't know where to put the money. They don't want to face the tax consequences. They might not all like the idea of going into a REIT for different reasons. If they own an asset, they want to replace it with an asset, not into a DST or into a REIT. So finding quality assets has been, you know, friction on the sales side and not being able to find good replacements. And then on the leasing side, I mean, some years the leasing market have been very good, but we have kind of lopsided equity or lopsided leverage in a couple markets. So anytime landlords hold a lot of power like they do in the industrial market, sometimes it's harder for tenants to bite that bullet. Or on the reverse with office, tenants have a little more leverage than owners do. And sometimes it's harder for owners to want to give in to finally get that space leased. And so just friction in deals when you've got lopsided leverage, that's something we're seeing and dealing with right now too.
No, these are all really good comments. I would say, you know, I really feel fortunate. Our company's doubled in size and we have not had a challenge with employees. In fact, we've got kind of a small waiting list. There's two things we do. We acquire property and we build property. So both of these, the biggest uncertainty and that risk is what I see. On buying an existing building, I think it's going to be the capital markets. Really, what is interest rate? What is it going to do? You know, right now we can lock it in at mid threes for 10 years. It takes a lot of risk out of the game. And then on construction, and it was mentioned, Tracy and others, but the supply chain is really confusing. So we've benefited from China producing a lot of stuff really cheap and shipping it over here. This COVID kind of disrupted that whole supply. We had a 72 unit 55 plus that couldn't get the elevator for 2 months. I mean, these are some core things. So I think one of the risks is not having enough suppliers in America, and it's going to cost more. So that's going to probably drive things up, but getting that supply chain, you know, for existing. So when you bid a project, you know what the number is. That's kind of the challenge.
Thank you. I guess we've kind of talked about it in the other panels, but does this group want to talk at all about the FM diversion, challenges posed, opportunities presented? If there's anyone that wants to comment on it, feel free. Otherwise, we can transition.
I can offer a couple quick comments. I mean, we've kind of been on a couple ends of this. We've represented some landowners. So there's a lot of benefits from this project clearly, and this is a huge deal for the community. But we've also seen the real personal side of the people who are being forced to sell their land. And so we've been at the negotiating table and we've helped some owners through that process. So I don't want people to forget about the very personal side to the FM diversion, because there are people out there sacrificing a lot for the benefit of many. But clearly the benefits to the community are going to be enormous. And I think, we heard that a little bit from the community leaders in the first panel. I mean, a $3 billion project, the people that are going to have to move here, eat here, live here, buy their things here, it is going to be a significant impact for the community. They're also going to have significant challenges, right? If we're all having a tough time hiring, they're going to have a tough time hiring. And so, I mean, I think we believe that they can get it done, but there's a big test. This is a big project at a very tough time to complete. And so I think they will have their own set of challenges, but clearly it will likely impact every component of the market here. And I think everybody should be prepared to see what that means for their own business.
I'd just like to ask Andy a question. So we heard from the mayor, I guess from Dave Pepcorn this morning, that they didn't want to encourage any development south of 52nd, which I was listening to that and I thought, well, again, if you're going to develop it today and you spend $100,000 to lift your site and build your site, and then 6 years from now, you wouldn't have had to spend that. It seems like, I mean, it kind of makes sense, but it seems like there's going to be kind of a pent up demand or there ought to be some solution to that, knowing that, again, the diversion's going to be done.
Yeah, I think Dan and I chuckled a little bit during the session when they talked about stopping development south of 52nd, yet we have a need for more housing today. The diversion's only going to impact that. We've sold a lot of land. It's kind of been a key area for our brokerage, is helping people buy and sell land from about 76th Avenue all the way down to 124th, which is the south border of the diversion. And there is a change in the political winds within the city of Fargo in terms of their willingness or ability to annex or extend services and utilities to some of these areas. Clearly there's demand. We've got developers and investors who are buying properties in those areas, and a lot of them don't want to sit on it for 10 years. They'd like to start making some plans. And so it'll be interesting. I mean, there's always a pendulum within city government and anything about, okay, now we're going to stop it, and then maybe it starts to loosen up. So I personally think they probably can't stay on that end of the spectrum for this entire time frame. It just, the market will dictate and demand it, and they can only hold out, I think, for so long before they will start to loosen up some of that development potential, because there's a lot of black dirt from 52nd Avenue down to this diversion project, and we're going to need some of it before that project is done.
I own some acres on like 25th and 88. We'll talk afterwards.
All right. Last subject. It's kind of around just lessons learned, learn through others. So, Rick, you've started by sharing, some of your just trends that you've seen and experienced since 1981. I don't know if you want to kick this off, or others, please chime in. But curious, what are you seeing? Lessons you want to share, or what are you hearing from your clients or your tenants? Are there any lessons learned you want to close us out on? Is basically the topic.
I have a 2-hour class on that later. No, I mean, again, the lesson I've learned is, think long-term. Real estate's a great investment. And I guess the other thing that occurred to me, I mean, I've been blessed by having an opportunity to interact with so many people. And to some way, we're all competitors, but there's also opportunities to work together in so many different ways. And so I think one of the lessons when I was 25, I always joke that I learned the most in my life after I knew it all at 25. And I just think, again, there's a lot of your peers here and professionals that, lean on them, work on them, and there's maybe opportunities to work together. So don't discount the real estate community. Tracy, go first.
Turkey. 2021 wasn't an easy year for our company. And we just had a couple of very unexpected deaths within the company and with children of employees. And so what I've learned through this last year and a half is just to appreciate the people, my community, how we've all lifted each other up. It's been a hell of a hard couple of years. In many, many ways. COVID, yes. Isolation, yes. Mental health issues throughout our community. But man, the amount of community and love like that I felt through our community and with my clients and the development community and so forth, it's just unreal. And we are really blessed to live and work and play in this region. I lived in Denver for 15 years. We didn't have that there. I mean, love Colorado, but it was different. Coming home and spending the last 10 years here has been just the best. And the last 2 years has just made me realize why we came home. And it's been pretty awesome. It's getting touchy-feely. This is getting scary.
I'm not nearly as old or as wise as Rick, so I'll go to more tactical things. A couple like interesting things I've kind of learned or seen. We talked about inflation. That's been a big topic. I've started to see some clients, and I think we'll start to see more pushing for CPI increases in leases as opposed to 2%, 2.5%. I mean, for years, we've just been, hey, it's a standard 2% increase, maybe 3s, you might get that. 6.9% is the latest year-over-year trend on inflation. So we've got an owner who's looking at every lease. They want to see a CPI increase, or maybe 95% of CPI, for example. So I think people need to start thinking about that as they're working on either buildings they own or tenants or owners they're working with. And then the other one that, in a market like we've got with industrial, it was always taught to me like, hey, if you've got a income producing property with a 5 or a 10-year lease, that's ideal, right? The owners and buyers will come out of the woodwork when you've got these long-term leases, credit-worthy tenant. More and more nationally, and I think it'll also start to happen locally, is in markets like industrial, where the market is so dynamic and so hot, buyers don't want a 5 or a 10-year lease on that property that they're buying. They might devalue that property if it's got a long-term lease. So some owners who are sitting there coming up on a rent negotiation, they have to keep in mind a little bit about what kind of a rent are we negotiating and how long do I want to achieve that rent, because in 2 or 3 years, maybe I'm way under market and now my property is undervalued. So that's a totally different thinking than we've traditionally had in the market for triple net long-term leases.
Good comments.
Well, I would probably just share maybe some Kilbourne Group team's perspective on our developments in downtown Fargo, and again, recognize community started this vision a long time ago, and through our our focus in downtown Fargo, we've certainly have come to appreciate that to have a really great metro area. This community needs new subdivisions to be happening, creating great new neighborhoods, safe schools, all the attractions that a community needs. We also need a vibrant downtown Fargo to attract workforce. I think altogether we hear the constraints that we have in workforce, and that means we need more people moving here so our economy can grow. And so we are certainly believers that there's a lot of different components and a lot of different types of real estate that's needed to attract the best workforce. And together, what I certainly hope is that our metro area, all the mayors and all the community members and in the politics of our area come together to think about how do we go compete against the other regional cities in the Midwest. There is more interest than ever in the Midwest, which is exciting and an opportunity for a city like Fargo. So we're excited to be doing that. Our focus is, of course, walkable mixed-use projects. We'll eventually be doing some project outside of downtown Fargo. We're excited about that opportunity coming up. It'll be something around mixed-use walkability, because that's what our team is certainly an expert at. But we see that demand is growing. It's not the majority of the demand right now, but we certainly see it growing, and we want to be doing those projects in the future.
You did? Oh, yeah. Yeah. Just to touch on that, I think what Andy kind of mentioned, it's something that we listed in our research report as well too, on the industrial demand. our appraisal team is evaluating vacant industrial more than a cash flowing asset right now because of the ability to increase those rents. So they're not, undervalued. And something that's interesting is for some of these industrial companies, transportation costs make up 40 to 70% of their total costs. The fixed facility costs or rent is really only 3 to 6% of their total costs. So the rent number is pretty minimal for them on the global macro level for when they're making these real estate decisions. It's about what's available in the market and what's there. In terms of market share, 38% of 3PL companies is what the market share was compared to 13% of e-commerce, in 2021. So we'll just continue to see that, kind of going forward, I think, in 2022.
That's great. Thanks for sharing. All right, folks, we have, I guess, a couple minutes for Q&A. Are there any topics out there? Questions? All right, Jeff, you want to close us out? Thanks to the panelists.
Yeah. All right. Hey, thanks again for everybody for joining us today for our annual Fargo event. Looking forward to being here again next year. And once again, thank you again to all of our sponsors, Whipley, Winthrop and Weinstein, Dakota REIT, JLG, Hyde Development, and CBRE. Thank you. Have a nice afternoon.